Hello, ladies and gentlemen. This is Thomas Fross here with Fross and Fross Wealth Management, where as always, we at least attempt to be the voice of reason in a world full of the pundits of pessimism and the wall of worry. As always, please make sure you read the disclosures that were attached to this video, or if you happen to be watching on social media, it's simple. Just go to www.frossandfross.com and read any of the disclosures that you might find therein. So it's hard to believe that we're already through 2023 and on into 2024. It seems like we were just at the beginning of the year. And when it came to stocks, well, they had a bit of a wild ride last year, surprising many skeptics. The Dow Jones, well, it hit a record high on December 28th, and the S&P 500 nearly touched a new all-time high with a whopping 20% annual gain. And it wasn't just stock enthusiasts celebrating. Bond portfolios, which really struggled in 2022, having their worst year in history, well, they made a strong comeback, posting a solid 5.5% return for the year. That was after being in the red just as late as October. The fact is, last year, it turned out to be better than most expected, especially considering all the pessimism that we were experiencing coming into the year. So what I thought I would do in today's commentary is look at some valuable takeaways for investors. So here's lesson number one. Don't blindly follow the crowd. The fact is they're right sometimes, but they're wrong a lot more often than you think. Wall Street forecasts for the S&P 500 at year end that were just taken in May of last year, they were way off the mark, 19% off the mark, proving that bearish trends can often be very misleading. Lesson number two, keep an eye on cycles and trends. Stocks tend not to fall 2 years in a row, so that's a cycle. And historically, the third year of a presidential cycle, like we just went through last year, that's been the most favorable. Historical averages looking forward suggest mid to high single-digit gains for the stock market in 2024. Third lesson, never, ever underestimate the U.S. consumer. Economic cycles may vary, but the post-pandemic recovery showed that traditional indicators can be very misleading. Stimulus measures like low interest rates and infrastructure spending, well, those really mattered. Also, consumers with jobs, they spend money. And remember that we have record low unemployment. Fourth lesson, embrace a long-term perspective. The unpredictable economic cycle in 2023, it reinforced the idea that time in the market is wiser than trying to time the market. And I realize I'm not immune to it. It takes patience during downturns, whether those downturns are due to wars, whether they're a banking crisis or recession fears. But regardless, it's time in the market. It's not time in the market. It's not timing the market, I should say. It's time in the market that's best for most investors. So as we step into 2024, it may not match the euphoria of last year, but with lowering inflation, low unemployment, strong corporate fundamentals, and the Federal Reserve ready to cut interest rates, we feel that the stage is set for another potentially profitable year. Now, this was simply an appetizer for our State of the Markets address that we will be holding at Rohan Rec Center on February the 15th at 2:30 in the afternoon. Invitations will be being mailed out. Please mark your calendars, and we'd love to see all of you there. In behalf of the entire team at Fross and Fross Wealth Management, here's to wishing you a joyful and prosperous 2024. Feel free to reach out to our office if you have any questions, and have a wonderful day.